This is Money Talks. I'm Greg Vogel, Portfolio Manager at GKV Capital Management. The financial markets do not react well to uncertainty. This time last year, investors were trying to price in the impact of tariffs. The initial announcement was shocking. Enough so, some economists were concerned that the economy could be pushed into recession. Tariffs ultimately were reduced, and earnings growth remained strong, and stocks rebounded, ending the year with solid gains. This year, it's the war in Iran increasing uncertainty. Oil and natural gas shipments from the Middle East are at a standstill, with implications for slower economic growth worldwide. A resolution seems near, but has remained elusive so far. Like last year, the headlines are worrisome. Consumer sentiment is terrible. Add the price of gasoline to the affordability crisis, and yet we're back to record highs in the stock market. Tariffs, political gridlock, rising debt, global conflict, concerns about artificial intelligence. So much uncertainty, it's a wonder the market is up at all. As stock prices move sideways for the first quarter of the year, corporate earnings forecasts continue to move higher. As a result, the market has been looking less expensive. Stock prices are based on expectations, not what companies earned last quarter, but what investors think they'll earn in the future. If the future looks strong, prices go up. If the future looks unclear, prices come down. And right now, the issue isn't that earnings are weak. In fact, earnings have been very strong, and expectations for growth are still high. Any event that has the potential to derail earnings expectations increases uncertainty and holds back the market. As the year progresses, if we have more confidence that strong earnings results can be met, we expect stock prices to move higher. It's not hard to pick out the few big things weighing on the market right now. The first is energy shock. Oil prices have surged, up more than 50%. That matters more than people realize. Energy touches everything. When oil gets expensive, it costs more to ship goods, it costs more to produce goods, and everything gets more expensive. That pushes inflation higher and slows economic growth at the same time, and that's a tough combination. The second is artificial intelligence. AI is a massive opportunity, but it's also a big question mark. Companies are spending hundreds of billions building out AI infrastructure, data centers, chips, power systems. But here's the issue. We don't fully know what the return on that investment will be yet. Are companies spending too much? Well, we just don't know. We also don't know which companies will win, how business models will change, or how jobs will be affected. That kind of uncertainty makes investors nervous. Related to artificial intelligence are concerns for the job market. You may have heard concerns about AI replacing jobs, but so far that's not really what's happening. Hiring has slowed, but across the board, not just in tech. This looks more like a slowing economy than an AI takeover. That said, companies are starting to think differently. Instead of hiring more people, they're asking, can we use technology to do more with less? And that shift matters long term, but right now it's still early. Here's what makes this moment interesting, though. Even with all the uncertainty, companies are still delivering strong results. Earnings have been growing at a very healthy pace, and expectations for next year are still high. At the same time, stock prices are a little changed for the year. That combination, rising earnings and sideways prices, actually makes valuations more attractive than they've been in a while. Another piece of the puzzle is interest rates. When uncertainty goes up, investors demand higher returns to take on risk. That pushes interest rates higher. And higher rates do a few things. They make borrowing more expensive, they slow down economic activity, and they put pressure on stock prices. So, ironically, despite President Trump's demand for an interest rate cut, rates have actually moved higher this year due to greater uncertainty and the prospect of rising inflation. So what happens now? Will energy prices stay high? Will AI investments pay off? Will the job market weaken? As those questions get answered, uncertainty starts to fade. And when uncertainty fades, markets tend to stabilize and often move higher. What should you do with all this? Well, first, don't confuse uncertainty with collapse. They're not the same thing. Second, recognize that volatility is normal in periods like this. And third, stay balanced. There's still opportunity in stocks if earnings continue to grow. At the same time, higher interest rates mean bonds are offering solid returns in the 6 to 7% range for corporate bonds. That gives investors a way to diversify and reduce risk. Real estate may stay lower for now since higher rates make borrowing more expensive. The key takeaway is this: strong fundamentals don't always mean rising markets, at least not right away. Sometimes uncertainty gets in the way, but over time, the data matters. If companies continue to grow and deliver earnings, markets tend to follow. The question isn't whether uncertainty exists, it always does. The question is whether you're making decisions based on fear or based on the bigger picture. For more detail on our analysis, you can download our quarterly update from our website at gkvcapital.com. You can also sign up for our email distribution list to receive our reports directly in your inbox. Thank you very much for watching.